Hey everyone, so we're going to go through this FIN115 exam. This is from 2015, it's the main exam. Okay, so let's start off with question 1. Okay, so we've got a company that operates leases large specialized trucks. So straight away you know it's going to be a question to do with leasing. So calculating, the present value of minimum lease payments, identifying whether it's an operating or finance lease, etc. So straight away by reading that, you know where the question is going, which section of your critical file you need to jump to, and which templates you need to open from the exam Bible. Okay, so let's have a quick look at the question. What I like to do is just skip ahead to the question just so I can get an idea of what information I should be looking for, and then after I've got that I'll read through the information up above. So the first thing it's going to ask us to do is calculate the present value of the minimum lease payments. Then it's going to be to justify the lease as a finance lease as opposed to an operating lease. And then the final step is to prepare the journal entries. Okay, so you can see 4 marks, 2 marks, 6 marks. Okay, so let's quickly read through the information. So there's a 5-year lease. It's a specialized truck. So looking for unusual information like that. So straight away, because we've read the question up ahead, we know that that probably fits into this question here. Is there a reason why it might be a finance lease as opposed to an operating lease? If you remember from the modules, the video modules, we know that a finance lease is often to do with something that's specialized that only the person leasing it can actually use, because it's either a long-term lease that's highly valuable, it's highly specialized, and they're taking ownership of it later. So we're looking for keywords like that. Okay, so it's got a useful life of 7 years, after which it'll have no residual value, which means that no value at the end. The fair value of the truck at the inception is 1.849 million. There's a bargain purchase option for 400,000 that the GM can exercise at the end of the 5th year of the lease, and they intend to exercise this option. Okay, so there's 5 payments of 450,000 with the first due on June 16. Depreciates the truck on a straight line basis. The cost to manufacture the truck is 1.6 mil. Okay, so the first question, calculate the present value of the minimum lease payments. So what this means is, look at all the cash outflows that the business is going to have to make, okay, and then add them all up, and then adjust for the time value of those payments. So for example, if there's a payment 5 years time, you need to make sure that that payment is reflected in today's dollars, because $1 today isn't worth $1 in a year's time or 2 years time. Okay, so first of all, we've got to consider what all the cash outflows are. So the first thing to consider is that there are 5 annual payments of $450,000. Okay, what else is there? So there's also a bargain purchase option. So here, the $400,000 that they can exercise at the end of the 5th year of the lease, and they intend to exercise this option. So because they're intending to exercise it, there's some certainty that we can recognize that, include that in there. So really, there's 2 types of payments. There's 5 of these and 1 of these at the end in year 5. So there's 2 ways we can calculate this. One is we can actually use we can actually build a table like this and put in each payment. Payment 1, payment 2, payment 3, payment 4, payment 5, and the residual guarantee. And then you need to include the dollar amount in each of them, but also the present value factor. So this number will basically reduce the value of a future payment. So that's one way of doing it. So we just put in the dollar value here, and then the present value factor over here, and then multiply the 2, and then add them all up. Okay, there is a quicker way, and it's actually in the exam paper itself. So if you scroll to the end of the exam paper, what they'll give you is, in each of the exam papers, is this present value table. So basically, instead of having to do that, and keep in mind you would have to actually use these present value tables either way to get that present value factor. But what we can do here is actually figure out what's the interest rate, how many years of payments are we including, and then Okay, so let's look into the question. So there's two things we need to know. First of all, are we just calculating 1 year of payment, or are we calculating an annuity? So an annuity means it's the same payment each year. So because we're going to do it the quick way, which is to calculate the value of the 5 years worth of lease payments, this is an annuity, so it's getting paid at the same time every year. If it was just one payment in year 5, we would use this table up here, because we want to know what's the present value of that payment. So there's two components here. So if we use this table as a template, we should be able to figure out our amount. Okay, so let's use this template here. So there's two components here. There's the the 5 years of lease payments. There's the bargain purchase option, the type of each. So there's an annuity because there's 5 years worth of these, and then this one's present value because we just want to know in the 5th year there's one payment. So what's the present value of that? So the amount for each of these payments. So this one is 450,000. Now keep in mind, you don't do 450,000 times 5, because when it's an annuity, you just times that by the annuity present value, which just calculates it based off the repeating amount. So you only do it off the single payment amount. And then the bargain purchase is 400,000. Okay, so to calculate the discount factor, we need to know two things. Number one is time. Okay, so time is 5 years. Well, yep, and this one's in year 5. And then the interest rate is, let's see if we can find it in the question, 12% over here. Okay, so let's put that in, 12% as well. And then if we just skip back to our exam papers at the end, there's the present value table. So the first one, annuity, this one down here. So we want to figure out what the discount factor is. So go periods is 5, and then the interest rate is 12. So we can find that that value is the intersection one, so it's going 3.605. And then the present value of the final payment of $400,000 in year 5, 12% is 0.567, 0.567. So what we have to do to calculate the present value is go amount times the discount factor, and then same for this one. Okay, and then all we're going to do is add it up, and this will be the present value of all of our payments. And that's it. That's how you get 4 marks. Pretty simple, right? So how you would get those marks is probably 2 for the correct answer and 1 mark each for the calculations. Okay, so let's move on to the next question, which is classifying justify, which means provide evidence to support their own judgment as a finance lease by providing 2 facts that support this treatment. So if you remember from the critical module file, the difference between a finance lease and an operating lease. So there's a lot of different things which would indicate a finance lease. So the lease transferring ownership, an option to purchase the asset that at a price that is expected to be sufficiently lower than the fair value. The lease term is for the majority part of the asset's economic life. At the exception of lease, present value of the lease amounts to at least substantially all of the fair value of the leased asset. The leased assets are of a specialized nature that only the lessee can use without major modification. So again, you can pretty much use any of these. I'd probably prioritize ones that you see immediately in the question. So for example, we saw that the lease is a specialized truck. So that's probably the first one that I want to use, just because it can be supported in the answer. That's always your best bet. And it's 2 marks, right? So you only need 2 answers. So that's one thing. Now what else could we do? We could also do the fact that the lease has a bargain purchase, which is in the question. We could say the fact that the lease is non-cancelable, which we mentioned over here. And we could also use that at the start of the lease, the present value of the lease payments is pretty much the whole fair value of the leased asset. Now this is another good one to use because it kind of leads on from the first question. So we calculated in the first question the present value of the truck, and they've also given us the fair value of the truck. So that's one of the things you kind of learn by doing these questions over and over, is that you need to be looking out for certain triggers that CA wants you to look out for. So it's kind of working you through a series of steps to get to this solution. Just keep that in mind. Once you remember all those identifiers between a finance lease and an operating lease, it'll help you look out for them in a question. Okay, so the final thing for 6 marks is to prepare the journal entries for the financial year ending 30 June 20x6 in the books of the lessor. Okay, so there's 2 immediate things that you need to be looking out for here. So first of all, number 1, journal entries. Your first response should be to go to the exam Bible, because this has all of the journal templates you need. And again, you can access this from our FIN critical notes. So please go ahead and download this if you haven't already. So you can see, for example, in the lease chapter, it's got all the different journal types that you need. And you just need to follow the template and use the numbers from the question. Now, the second thing to look out for is whose perspective are you doing the journals from? Are you doing it from the person who is leasing the asset, so renting it out? Or are you doing it from the person who's manufactured the equipment and then leasing it to make money to someone else? So think about it like a house. Are you the tenant or the landlord? Okay. Now, it's confusing because lessor and lessee are so similar. But just remember it, and in the exam, if you're not 100% sure, you can always look it up and see which one is which. So actually, lessor means the person who actually is the landlord equivalent. So the person who owns the asset and is leasing it out to someone else. So a lot of people are immediately going to get tricked by this question and start preparing the journal entries from the perspective of the person who is leasing out the truck, not the manufacturer. Okay? So just be super careful whenever you see a lease question. Make sure you are journaling from the right perspective. Okay? Because it's an easy way to lose marks on a not so challenging question. Okay, so the first thing that we want to do is then now go to our exam Bible, and we understand from whose perspective we're actually accounting it from. So we want to go to the journals for the lessors, not the lessees. Okay, unfortunately this question is a little bit complicated, but the first thing we want to do is scroll down to accounting for lessor, so make sure we're accounting for the right person. Okay, now let's go to our journal steps. You don't need all of the above, which is calculating the present value of the lease payment and the payment schedule, because we already did that in part A. Okay, so this is the important part and the tricky part. So for accounting for lessor, there's a few steps. So number 1 is initial recognition. So ordinarily what you would do is you'd recognize, first of all, a receivable. You'd recognize the receivable of the loan, and the credit will go to equipment, right? Makes sense, because your equipment's going out and your receivable is going up. Makes sense? And if there's any initial cost incurred, you'd recognize that against the receivable amount as well, if that's applicable. However, and this is a big however, if the company is a manufacturer or a dealer lessor, it's a little bit different. What happens then is they should include the selling profit loss in the same period as they would an outright sale. So instead of doing just recognizing the loan or the receivable and reduction in the equipment, what they actually have to do is recognize a sale at the same time. So this is why this question is really tricky. If this wasn't a manufacturer or a dealer, if it was another lessor, then you would just follow it exactly like this. But you got to remember that there is a bit of a different situation for manufacturers. Just keep that little trick in mind. Okay, so it's still effectively the same process. We're still going to recognize it, but we're going to recognize the sale at the same time we do. And then after that, the journals are fairly similar. So you recognize interest, income component, receivable, cash, and so forth. Okay, so if you follow the journal structure, the first step is we have to recognize the lease receivable amount, and that's effectively going to be the present value, which we calculated in question A to be 1849050. So the first journal is going to be debit receivable 1849. And on the other side, instead of going credit asset, what they're going to do is going to credit revenue, because they're actually in the business of selling that. Okay, so that's the first journal. Now, whenever you do a revenue journal, you got to consider, okay, what's the cost of that? Because there's always going to be a cost of sale element in there as well. So what do you think it's going to be? Well, the cost to manufacture the truck was 1.6 million. So what that means is the cost of goods sold was 160,123, and it also means that their inventory is going to go down because they're selling their truck. Okay, so there we have it. We have recognized the liability in the exact same way that we would have done it for a non specialized manufacturer. And then we just go on to the regular journal entries. So first of all, we want to go cash for the 450k. Okay, so what actually goes in here? Lease receivable and interest income. Okay, so it's the same way you'd calculate a loan, right? So you'd use this payment schedule up here. So let me just bring this over here. And ordinarily you do this for every single year, but just for the sake of speed, we don't actually need to do every single year. We only need the first year's payment. So how it would work is you'd start off with your opening balance. Okay, so opening OB is 1849, and then you're going to apply your interest income, which is at 12% times 0.12, and then the receivable reduction so this is the reduction of the payable amount for the lessee, is the difference between B and D. So this is B, interest, and D is receivable. So we know, sorry, that's lease. So we know they're paying 450k a month, and therefore the difference is 228. Okay, and then the closing, which we don't need to do, but in a longer question we'd have to do this for every single month. You'd go A minus C, which is equal to the opening balance minus the receivable reduction, which is basically, in short, what you're saying is it's just like a mortgage. Your balance is always increasing with interest, and then you're paying it off, some of the balance and some of the interest, right? So even though you're paying 450k, it's not all going to reduce the loan. Some of it's paying off interest, some of it's paying off the balance. So really, the balance is only reduced by this portion, which is the actual equity reduction. And then you just repeat it. Okay, so for year 2 it'll be 1.6 and so forth. But for this question, we only need year 1. So we only need these two. So these are the things that are going to comprise our final journal. So it's going to be debit cash. Keep in mind this is coming from the perspective of the lessor, the person renting it out. So they're going to be receiving the cash. So that's going to be 450k. And then they're also going to have a interest income, which is that. They're going to have to recognize that income. And they're also going to have a reduction in their receivable amount of this amount there. So there's our journal. They all balance out. And that's basically how you answer this question here and get a full 6 marks, and then 12 marks in total for question 1 completed. Hey guys, so the second part of question 1 is they've given us a extract of statement of financial position, so a balance sheet effectively. Let's have it as before. Let's skip ahead to the question just so we can see what we're being asked to prepare. So we're being asked to prepare a statement of cash flows. Okay? You don't need to prepare disclosure notes, just prepare the cash flow statement. Now again, going back to our journal templates from the exam Bible, this tells us exactly what we have to do. So before you even look at the information, look at the question, open up the exam Bible template, and look, it's got the template that you need to use for the question. Alright? Now the end result is going to be this. This is a statement of cash flow. What it does is it shows the net cash flows from 3 different areas, so operating, investing, and financing. And then what you do is you have a net increase / decrease in cash for the year. And then that'll equate to a balance of cash. So you might have 100 million in cash last year, and then net cash inflows of 20 million, so your closing balance is 120 million cash. That's all you need to do, okay? However, to get to a few of these steps, these numbers, for example, receipts from customers, what you need to do is actually prepare a thing called T accounts. And a T accounts is a way of actually, for you to calculate what that number is. See, that corresponds down here to this T account here. And it actually allows you to work backwards using some of the other balances like sales, revenue, and trade receivables and so forth. Okay, the first thing you'll note is that the question only asks us to calculate the cash flow from operating activities. Now, as I said before, the cash flow is generally split into operating activities, investing activities, financing activities. But, in real life and in exams, it's 90% covered by operating activities. So this includes things like, sales, receipts from your customers, your cost of goods, so your payments to suppliers and employees and so forth. It also includes like interest income, and interest paid and so forth. So they're really the common ones. So what I'm going to do is I'm actually going to set up my cash flow statement here, so we know exactly what values we have to put in here, and this will be what our 6 marks will be based on, as long as you show the working as well. It's really important to show the working. So to be able to calculate each of these based on the information they've given us, what we can actually use is T accounts to work backwards. And whenever you see a cash flow question, you're always going to have to do T accounts, so you might as well learn how to do them. So what a T account is, it's basically a combination of balance sheet and P&L, and it should basically reconcile so that they all add up to 0, or they should all equal each other. And some of that information, for example, receipts from customers, is the information that we need up above to complete our cash flow statement. But it just so happens that that's the balancing item between the information given to us in the question. Okay, so let's have a look quickly. So the first thing that we're going to look for is the opening balance of trade receivables. And you'll note, by the way, that all of these, I haven't just copied the answer. Look, they're exactly how it is in the exam Bible. So you can just copy the T accounts exactly how they are. Okay, so let's look up this information. So opening balance trade receivable. Okay, so we're going to have to look in the prior year to get the opening balance. So here it is over here, 800. Now, impairment loss. Now there's actually none in here. P&L. There's actually none in here. Trade receivables. It's on the other side. Okay, so let's look for the closing balance of allowance for impairment loss. So there we have it there. Negative 40. Okay, now because this is a credit amount on the balance sheet, it's a negative asset. next one's going to be 40. Okay, now here's an easy one. Sales revenue. We can get that from the P&L over here, so 1500. Okay, so you'll notice that the total's now been updated. Now, closing on the other side, closing balance, trade receivables. So that's going to be 300 over there. What else? We've got opening balance, allowance for impairment loss. So that's going to be 100 over there. Then we've got impairment loss expense. So we've got to look in the P&L. There it is there, impairment loss. So 125. Okay. Looking for bad debts. Don't see any in the question. And then, so we're going to put that as 0. So therefore, the balancing difference must be receipts from customers. So we can work out that this equals that, and therefore this is the difference between all of these. So there we have it, receipts from customers. So we can complete our first value of our cash flow statement for operating activities. Okay, so the next thing we want to do is do the same approach, but for payments to suppliers and employees. Think of it as your cost of doing business. Okay, so the next thing that we're going to do a tier count for is this, payments to suppliers and employees. Now this is a tricky one because there's a few different areas where we're going to have to actually adjust for in our tier count. Okay, so those 4 things are inventory, accruals, trade payables, and employee entitlements. Now, as a first check, let's just make sure that those are actually on the balance sheet and that we're not missing anything else. So looking for anything to do with suppliers and employees. Okay, so trade receivables, that's important for suppliers because you're buying from suppliers. You've got an impairment loss for trade receivables. You've got inventory, so we need to cover that. Deposits at call, not really relevant. Interest receivable, not relevant. These are all like investing things. PP&E, not relevant. Okay, trade payables, that's relevant, so we've got that down there. Provision for employee entitlement, so really we were looking for working capital style items. So not debt, not cash, we're looking for working capital. So inventory, payables, accruals, employee entitlements, and so forth. So it looks like we've covered everything there. Okay, so let's start off with inventory. Okay, so a few things we're going to need is, depending on which side it is. Okay, so the assets go on the debit side, which is on the left, and the liabilities go on the credit side, which is on the right. So let's start off with inventory. So we always put the opening balance in the same column that the debit is in or the credit is in. So because inventory is an asset, we want to put it in the debit as our opening balance, and then our closing balance is going to go on the other side. Okay, so the next thing we've got to look out for is what are things that increase it, so like purchases of inventory. Okay, so that's going to be on this side, got the debit. Whereas if it's decreasing it, we want to put it on the other side. Okay, so there's actually no purchases, they've just got cost of sales. Cost of sales is a combination of purchases, closing balance, etc. So what we can do in here is we can work it out by taking the difference. So what we can do is put the negative value over here, the cost of sales. Okay, and we'll figure that out in a moment. So the next thing to look at is accruals. So accruals is a liability. So we're going to put our opening balance on this side. So we'll go accruals, opening balance, accruals, closing balance. Okay. Now, is there anything which is increasing our accruals? It doesn't look like it. Okay. That's fine. We can just work out the difference in here, net of everything. Okay, the third thing is trade payables. So that's a liability. So similar to this, we're going to have our opening balance on the right. And our closing balance on the left. Okay, and anything obviously that changes that is going to come into our net difference figure when we do the rec. Okay, what else? We've got trade payables, and then finally employee entitlements. So because that's a liability, we're going to have the opening on the left. I'm just going to call it EE for simplicity. Do we have anything that's increasing it in our P&L? So we do. We've got our employee benefits expense. Okay, so that's actually something that we can factor in. So what that is doing is it's making our liability bigger. So we're going to put it on this side. Okay, we'll just have a quick look through the P&L, make sure that there's nothing that's been missed. Okay, that's fine. Okay, so it looks like we've got everything now. Alright, so let's find out what these balances are. So inventory closing or inventory opening balance should be 650. Inventory closing balance should be 1150. Okay, cool. Cost of sales is 680. Accruals opening balance 225. 200. 65. 750. Employee opening is 100. And then employee entitlements closing is 125. And then employee entitlements expense is 395. Okay, cool. So it looks like we've got everything now in here. So what I'm going to do now is I'm going to add up each of them. Okay, and again, we need to add in our balancing adjustment somewhere, because the difference is basically our payments. Our payments to suppliers. And this is basically the missing part, which gets to our movement between our inventory, our accruals, our trade payables, our employee entitlements, all of our working capital items. So this is basically the purchase difference. And if this doesn't quite make sense to you, what we're doing, think about how cost of goods sold is calculated. It's the difference between opening balance plus purchases equals closing balance. Now, we have the opening and the closing, but we don't have the purchases. But the purchases is what goes into the cash flow statement. So what we have to do is we have to take the opening, closing, and then using that we can figure out what our payments is. That's basically the process we're doing, but not just for COGS, but for all kinds of, kinds of payments in the balance sheet, P&L, and cash flow statement. So this can be calculated as the difference between that and that. Just be careful of your circular reference here. Okay, just hard code that. Okay, perfect. So it balances. There's our payments to supplier. And there is the second part of our question done. We've only got to do interest now. So similar approach, we're going to do another T account down here, this time for interest. And we're going to go, okay, so let's have a look on the balance sheet so we can figure out what our interest revenue is. So our interest receivable is So first of all, it's an asset, so we want to put it on the debit side. So our opening balance, and then our interest closing balance. And then, okay, so what's the movement that's going to adjust our interest? Well, we know what our interest revenue is going to be. Okay, because that's going to be increasing our balance. The difference must be our received, our cash movement. Okay, so now our interest revenue is 15, and we know our interest opening is 0, and our receivable is 5. That means the difference is 10. Okay, I'm not going to bother with the totals. Okay, so it balances out. That means our interest, which was what we're after, because we're after cash, not profit. So we only care about what actually cash has come in. And then if we do the same for interest expense as well, this will help us figure out what our interest paid amount is. So again, same approach, but this time we're going to do it from interest payable, which means we're going to reverse our opening and closing, and then our interest expense and interest paid. Okay, so our interest expense is 30. Our interest interest payable. Okay, because there's actually no interest opening balance but closing balance, but there is an interest expense, what that means is to get to 0 to 0 but plus 30, it means there must have been an interest paid of 30. So there we have our cash flow amount over here, 30. Okay, let me just get the signage right. So payments going out are negative. And there we have it. Let's just sum this up, and that should be a full 6 marks question.